Okay, we're going to go ahead and record this. Okay. All right, everyone. Sean Ruggiero, thanks for joining us today. A little bit of a different topic. As you know, I normally um, talk about annuities, retirement planning, but the Advanced Market Sales team, the AMS team, is just that. We are the Advanced Markets team. Advanced can seem a little intimidating. It's not, but there is some planning in insurance and financial services that goes beyond a simple final expense or mortgage protection policy. And I think having an understanding of that is important because you want to be able to help as many people as you can. That's what makes this presentation so attractive. Everyone needs life insurance. Now, please understand, as an IAR, investment advisor representative, as the owner of my own RAA, registered investment advisory firm, I have a fiduciary rule. I have to, by law, do what's best for clients. So when I say everybody needs life insurance, I truly mean that. And that should empower you. When I got into this industry, I felt like I was doing something that was a niche. I felt like, okay, I'm trying to sling life insurance. I'm trying to sell people something. Well, yeah, it's sold, but life insurance is needed by everyone. Think about the popularity of opening restaurants. Now, a lot of restaurants fail. I get it, but why are restaurants so attractive? Why does McDonald's make money everywhere it goes, whatever the franchisee opens up? It's because they service something that is an essential need for people. They feed people. All right. Why is property and casualty, home and auto so popular? Everybody wants to go out and start in the home and auto business. Matt Smith and I started in 2005, something like that. And we did life insurance, we annuities, but we also did home and auto because everybody needs it. By law, you have to have it. It becomes a commodity. Well, I want to change your mind a little bit and help you understand that every single person needs life insurance. That's coming from a financial planner. You need life insurance. And if you know everyone needs it, you're going to feel emboldened and you're going to feel good about what you're doing. So we're going to discuss 5 reasons plus some ancillary stuff, some important things going on how everyone needs life insurance. We're going to start, though, by going 1,000 feet up. And Bridget, can you confirm that my screen is being shared?
It is being shared. You're good.
Okay, thank you. That was not the case last presentation. Let's talk about the proper financial pyramid. Now, when I say financial pyramid, this was not, it's not a pyramid scheme. It's not something that was created by insurance salespeople to sell more insurance. This was created by doctorates. This was created by economists and mathematicians and financial planners. It's actually the variation of this question is both in the CFP exam and the RICP exam, talking about how to properly build a financial pyramid, right? How do you go about creating financial health and wealth? Well, the first thing you need to do at the base of the pyramid, the largest section, is the protection. The foundation of this is protecting yourself, because if you don't have protection, then everything else will fail if something happens to you. Period, plain, end of the story. We need savings, we need growth, we need risk. And at the top, notice as it tapers, that's where we see things like risk. If I were going to compare this to, say, the essentials of life, something that everybody would understand, at the bottom, it would be food and water, and then clothing and shelter. And then as you worked your way up, you would have things like cars and boats and non-necessities. When I say it like that, it makes perfect sense. If you had, $10 to spend, you wouldn't go around trying to find a way to make a down payment on a boat when you didn't have any clothes on your back, when you didn't have any food to eat. That'd be ridiculous. But people abuse this in today's world because they have no true idea, and honestly, they feel disconnected from their finances. So our job as agents is to connect people to the finances, analyze where they're at, know what we do. We help in that bottom part right there, and we can help with savings and growth with things like annuities and IULs. But our primary function is to lay the foundation of it. And with the younger generation especially, you see an almost inverted and unstable financial pyramid. Because I know people, and we talk about this as a team. I know people who come to me and they say, I've got $1,000 to invest. Now, by the way, they have $6,000 of credit card debt and how much student debt or whatever it is. And they've got their Robinhood app, okay? And they want to buy GameStop. And they ask me if that's a good idea. I mean, it's absolutely crazy. Well, is GameStop, which trades way, way, way above its fundamentals, so it's an absolute speculation. It's the epitome of risk. Is GameStop and the $1,000 you invest in it, is it going to feed your family if something happens to you or if you're disabled? And the answer is no. You got to start at the bottom, as boring as that is. And when we encounter people, we're going to find that they usually don't understand this and they're usually not protected. That's our job. So now as we go through the 5 reasons why everyone needs life insurance, you're going to become a little clearer on where that fits in their overall financial planning and how we build that financial pyramid. So the first reason is the one that we all know. It's ensuring your human capital. Another way of saying that, also known as protecting your loved ones. When we go out into the homes, this is what we talk about the most, is how do we protect our loved ones? And the way I like to talk about this is what I put here in the bottom caption. Who will take care of your family when you're gone, right? Who will take care of your family when you're gone? Now, if I do this in front of an audience, and our audience is virtual right here, I would ask you, what do you think your chances are that you die before, say, 50 years old? And statistically, it is low, especially if you're insurable, right? If you're insurable, your chances are low. But now think a little bit further, and I did ask Bridget for permission to discuss this. Do you know anyone who was tragically killed or died prior to age 50, whether it was in your exact family or in a family you know? See, now it becomes much, much more real. Personally, I think of Bridget. When I think of Bridget as a friend who I've known and worked with since she was 15 years old. When she first got married and she moved to Utah, her first husband tragically died. He tragically died, and she's still in her 20s and pregnant with her first child. Did you anticipate that happening? No, but an investment in GameStop, a few shares of whatever, weren't going to be enough to take care of his wife and his child when he died. Okay, but that's what we do with life insurance: is we protect people's human capital, and we do it to protect our loved ones. Because who's going to take care of your family when you die? In many cases, it's someone who's ill prepared or can't take care of them. So your job is to make sure you're taking care of your family. The idea is this: as we start our journey as an adult, as a professional, as a craftsman, whatever it might be, we're going to exchange that human capital for a financial capital. And then later, we're going to live off that financial capital. So what happens if during this human capital exchange, during this time period early on, if something happens to you? If something happens to you, you now have limited or eliminated the ability to save up financial capital. So when we're protecting people, we're protecting their human capital with life insurance. Let's look at the facts. The average American will earn over $3 million in their lifetime. The average American will earn over $3 million in their lifetime. What happens if they die too early or halfway through that process? Statistically speaking, okay, and this is according to the Insurance Barometer study of 2020 by LIMRA, only 54% of people have insurance. So I want everybody to pay close attention to this. Only 54% of people have insurance. The average person makes $3 million in their lifetime. And of that 54%, 27% are insured with group coverage that's usually not in place when they actually need it. It's rarely portable. So the market, what we call the TAM, the total addressable market, is massive. I understand as agents, we become very reliant on leads, and that is awesome. But think even bigger. Everyone you see, well, technically, statistically, about half of them don't have insurance. And of those half who do, 27% of those, it's probably group coverage. And they just haven't truly been approached. Another thing that I would like to challenge each one of you on is the $3 million. Right, Will, we talked about this. We have agents making $150, $200, $250, $300,000 a year. Did they take a policy out? Yeah, they have a policy for $250,000 or $200,000. So if you die, you're literally replacing 1 year of income. Right now, ask yourself, how much life insurance do you have? First, do you have life insurance? Okay. How can you sell something you don't believe in? All right. And this is not a push to boost our sales. This is something I believe in as a fiduciary. How many of you don't have life insurance? Okay. And those that do you have 3 million, 4 million, 5 million? I can can tell you two things. One, I own 2 fixed index annuities. 2, I own 7 figures, multi-7 figures of life insurance. I use National Life Group. Okay. So think about that. These are the facts. And if you can't buy into the facts, then how are you going to sell it? And how are other people going to buy into it? Americans are underinsured. Okay, so that's reason number one. That's the obvious reason. That's the reason that everybody thinks of. Okay, when we pull on the heartstrings and we say we need to protect the loved ones, the financial capital or the human capital that you have needs to be protected for your loved ones. Who's going to take care of your family? Number 2, to cover your final expenses. Now, the final expenses, what I love about final expense sales is it's real. It's gritty, but it's real. A funeral alone can cost nearly $10,000. And does anyone know the amount that Social Security will pay you? I think it came out in 1939 when Social Security first was invented, and it never changed because they said we're essentially not going to be able to pay for people's funerals. And I'm not talking about the COVID exemption where they pay people $9,000. I'm talking about under normal circumstances, it's $255. So it's less than $300. Is it fair to ask your loved ones to cover the rest? Is it fair? And when you're talking to people, people will dodge this a lot. People will hide behind the facts or behind the lies that they've created to cover up the facts and the truth that most people you sit down with are ill prepared. And so they're making a choice, right? They're making a choice and saying, if I die, I'm going to burden my loved ones, or if I die, I am going to unburden them. It is a simple fact. Now, I have 4 answers up here. What percentage of Americans do you think die with debt? 36, 45, 68, 73%? What percentage die with debt? 73%. I want to see if anybody commented. I'm always curious. 73, yeah, Darren had it. So 73% of Americans die with debt. Why is that important? Understand your demographic. When you go out and sell final expense insurance, you can be based on a neutral swath. You can bet that 73% of the people you're dealing with have debt. So if they have debt, how in the world are they going to pay for the funeral expenses? So it's a very simple thing. You don't have the money to sell it. And if you say no to this life insurance policy, you're saying my loved ones can deal with it versus you dealing with it. Plain and simple. So Americans are dying with debt. Funeral expenses are not covered. What are we going to do about it? We can sell them a final expense policy. Number 3, protecting financial capital. So now we're going to get away from the what I would say the obvious ones, and we're going to talk about the ones that you might have not sold before. Maybe the more affluent, maybe the people that are self-insured, right? And self-insured is a real thing, but what I've always found funny about that is when someone says I'm self-insured, but the money that they have set aside to self-insure is the money that they need to live in, or it's the money they're going to use to pay off their home, or it's the money they're using to invest and create income. Well, it can't be both things. It can't be 3 things. Hey, if you figure out how to make money be 3 things at once, I'm all for it. But when we're self-insuring, we are literally setting money aside in case we need something as insurance. And most people misuse that. So challenge people, okay, it's self-insured money. Well, my understanding is your 401k. It's going to be subject to RMDs. It's in the market. It's going to have fluctuations. And don't you need to live off that money once you retire? See, that's not self-insured. But what I want you to focus on is we can protect that financial capital. So yes, we talk about protecting human capital, the obvious one. How are we going to make sure your loved ones are taken care of if you die? But now let's talk about protecting your financial capital, the one that you might be missing out on when we come into certain candidates or clients who think, you know what, the insurance premium's too expensive. I'm going to pass. I've got enough assets. I can self-insure. Because when the time comes, what assets will you liquidate when you need end-of-life care? Okay, and that's really the key question. What assets would you liquidate? So let's look at Mr. or Mrs. Self-Insured. Right? They've got shares in Amazon. They've got the classic Stingray Corvette. They've got the condo on Miami Beach. Maybe they've got a boat, a second home, or a paid-off house, and a stack of emergency cash. Okay. Now, Mr. or Mrs. Self-Insured has a heart attack, has a stroke, needs in-home care, needs to bring in some ramps and pay for a nurse to come administer medicine and all these different things. I have a question for Mr. Self-Insured or Mrs. Self-Insured. Which do you liquidate first? Which do you liquidate first? How about the shares of Amazon? No. I don't want to sell the shares of Amazon because when I die, my kids are going to get a step up in basis, and these shares are going to be worth so much to them. I don't want to touch the shares of Amazon. Well, how about the Corvette? You could sell the classic Corvette, the Stingray, right? No. Susie loves the Corvette. Susie loves the Corvette. I'm not selling the Corvette. Well, the condo in Miami? No, my wife wants to live there when we die. My wife wants to live there. Well, how about the boat? How about the boat? Boats are really tough to sell, and I think that she's going to get a bad price for it. She doesn't know what she's doing. And the same thing with the house. I'd like to keep the house in the family. Todd's got 6 kids already. Wouldn't it be nice for him to have a house? Well, emergency cash. That's what it's there for. It's emergency cash. But what if I have an emergency? See, people have assets, but they don't have a plan. Life insurance is agnostic. Think of it like a shield. Like you ever see Star Trek or these space movies where the shields are up, okay? And they're taking these laser shots or torpedoes, and it's dwindling the shield down. The shields are at 50%. The shields are at 20%. But it's there to protect them. See, life insurance, no one has an emotional attachment to life insurance. I mean, if I have a $5 million policy and I die, I'm glad I had a $5 million policy. I'm not looking at like I just screwed up a step up in basis, or Susie's not going to drive the Corvette, or my wife can't live in the condo. See, life insurance not only protects your human capital, it protects your financial capital. And when we look at policies like America, when we look at policies like National Life Group, F&G, I could name a list of them, North American, one of our new carriers, we're looking at living benefits that allow them to spend down the life insurance rather than liquidate the assets. It's very, very powerful. Reason number 4, and this dovetails into that more affluent, protecting your estate and covering your taxes. Now, I try not to get too advanced with this stuff, but that's what the advanced market team is here for. If you get into someone that you honestly feel needs insurance and you want a little help on these, please submit these scenarios to us. That's what we're going to talk about. But when we get specific about protecting your estate and covering your taxes, I want you to learn something here. And it's something that we don't think about, especially when we're kids or at a certain level of wealth. We just figure we're never going to get there. But there are people who now, and especially in the future, will be faced with higher estate taxes when they die. So you've worked a lifetime to create the wealth. Do you really want to give it away to taxes? Democrat, Republican, no one wants to give their money away, okay? People love spending other people's money, but not their own money. They don't want to give their money away. So I want to show you this. And when you get these slides, pay attention to this. This is the historical estate tax exemption and then the tax rate. So if we look back to 87, 97, and you can talk about presidencies, things like that. Yes, it will kind of follow based on a Democratic or Republican Congress. But if we look back from 87 to 97, the exemption was $600,000. Think about that. In 1997, the advent of the .com age, $600,000, meaning that I could die. Let's say I was single. to not complicate things. If I died, the first $600,000 I didn't pay federal estate tax on. Anything beyond that, I did up to a rate of 55%. Holy cow. Holy cow, right? That's crazy. Well, that was from 87 to 97. It's a long time. And then in 98, it creeped up to 625. In 99, it creeped up to 650. It eventually got to, after these millionaires were being made in Silicon Valley and all over the world. The United States is still a very affluent country. 2002, it's still only 1 million. I mean, we're not even outpacing inflation. 2008, it's still only 2 million. Okay, it's in more recent years. 2010, it hit 5 million. Notice there's a zero. That's a funny thing. In the last session of 2009, they forgot to extend the estate tax exemption. So actually, for the first part of 2010, there was no estate tax. That would have been the awesomest time to die. But now 5 million, right? And that's when the new law came in that would be 5 million per person, and it would grow with inflation. And then with President Trump, it went up to 11 million per person. So if I die, I have an 11 million exemption that passes on to my wife, who has another $11 million exemption. And look at the tax rate, it's going down. Okay. Let me ask you this. With COVID bailout money, with more welfare programs than there have ever been before, with a higher population, with a commitment to rebuild the infrastructure of the country, and with whoever is going to be in office, it almost doesn't matter. Do you think the future estate tax exemptions will go up or down? I think they're going to go down. I think the exemption is going to come down back to a more quote unquote realistic amount, and the tax rate could go up. Would you live and work a lifetime, create $20 million, $10 million, $5 million, only to give a third of it away? Of course not. But you've got to start preparing for this. So this is the intelligence of life insurance planning. Let me show you an example. Let's say in the future, and in the very near future, they drop that estate tax down. Okay, let's say 5 years from now, the estate tax is now back down to 5 million or 4 million or 2.5 million. And I'm looking at a client who has an estate. The estate is worth 5.95 million. And you can see it's comprised of $2.2 million in stocks, $1 million in bonds, some collectibles, some cash, and 2 different houses. Okay. What I'm showing them is this. We can reallocate $200,000, and this is a slightly hypothetical situation, but we do this all the time in advanced planning. We could reallocate $200,000 at stock and purchase a permanent life insurance policy for $1 million, right? That's great. That's pennies on the dollar. That's how life insurance works. You want to put in X, you want to get Y, and Y is going to be bigger than X. You do it at a time where you're relatively healthy. You can do a single pay, you can do a 7 pay, whatever it might be. But now think of it as just buying a slightly different stock in that portfolio. And that stock is worth a fixed amount, right? Which is fantastic. And now you have technically increased your estate from 5.95 million to your collective estate to 6.75 million. And what you've done is you've taken $1 million and set it aside in something called an irrevocable trust. An irrevocable trust. Now, guys, I understand this is a little bit more complex, but you will run into people, or you might know people who are affluent. Those people should not have their blinders on. They should be looking forward and saying, I don't think I'm going to die in the next 10, 20 years, maybe, right? Maybe 30 years, maybe 15 years, whatever it is. But I am not totally confident that the exemption tax is going to stay so high. Why don't I hedge my bets? Because what happens is now when this person dies, the $1 million tax-free benefit goes to pay off the taxes and the estate is left intact. This is estate planning 101. And it is the 4th reason why everybody needs life insurance. 5th and last reason to create a legacy. All right. I read a book recently, Seasons of Life, and it talks about a reminder. It talks about, what do you want written on your tombstone? I don't think anyone leaves this earth and puts in their tombstone, had the fastest car, had the biggest wallet, had the most zeros in their bank account. See, that stuff is what we compete for, and it contradicts itself. It's what we consume ourselves with. It's what stresses us out most of the time. but it's not what we're remembered by. We're remembered by what we've done for others. And a final gift of generosity can make up for a lifetime of mistakes. Keep that in mind, because when we will encounter people, because I've had people ask me before, what about the person who's 62, has no kids, no wife, no dog, no goldfish? Why would they have life insurance? To leave a legacy. To leave a legacy. Wouldn't a $100,000 tax-free gift to a charity make a difference? Wouldn't that be something they could put on their tombstone versus this person died with no kids, no wife, no dog, no goldfish? Absolutely. So creating a legacy, I could argue, yes, protecting human capital, protecting financial capital is important, but creating a legacy is huge, and it applies to everyone. And why is life insurance the best way to create a legacy? Because it passes tax-free and free of probate. And you're always going to get pennies to the dollar, right? You're going to spend less money than what you put into it. Let's take a look at this. I've had people that say, okay, well, Sean, I already make donations to a charity. All right, I donate to the Boys and Girls Club or whatever it might be, and that's great, and continue to do so if you want. But let me challenge that with two different things. First, what makes a bigger impact? What's a legacy maker, right? What are we going to point to our back and score the touchdown and spike the ball on? $200 a month or a $100,000 lump sum? A $100,000 lump sum. It's the $100,000 lump sum that makes the bigger difference. By the way, you can change your beneficiaries. You can divide this up however you want, because another thing to remember is you might change your mind. You might find out there's a scandal, okay? You might find out that there is an issue with management or a change in affiliation, and you no longer want to give money to that company or to that entity. You can now change it. And also, what if you need the money? What if you do get married late in life? What if you do adopt a kid? What if you need money because your investments tanked? We had the worst market crash of all time, and you need something to pay for your end of life care, right? Or go on a vacation or whatever it is. See, you can do that through life insurance. You can do that by electing to leave a legacy. So charities, and charity doesn't have to be a bad investment. What I show you here is a report that comes on the Mutual of Omaha illustrations for the IUL Express, one of my favorite policies out there. So if you look at this, at age 61, the client takes out a policy for $2,400 a year, $200 a month. And the death benefit is $84,000. Now, if we look at the previous year, the death benefit, year one, the IRR, or internal rate of return, is 3,402%. Now, what am I getting at there? Well, if you spent $2,400 and got 84,000, you just got a return of 3,400%. Okay, because it paid off so much for so little. But even if you live to say 80 and you put in $48,000, it's still worth 5 times that much. The internal rate of return, I'm sorry, not 5 times as much. The internal rate of return is a 5% internal rate of return. It's not a bad deal, knowing that you've got a guaranteed payout. It's tax-free. It's tax deductible if you give it to a charity, and it got a little over 5% internal rate of return while you put the money away. And even if we go later in life, while the internal rate of return starts to shrink down to the 2s, okay, what is building? The cash value. The cash value is building, okay? So internal rate of return is a real thing with life insurance. And sometimes we don't talk about that because life insurance is not an investment. But if we're putting something in that's going to be worth more than what we put in, and it's tax-free, and it can be tax deductible if it's paid to a charity, you're looking at a great way to leave a legacy. Now, we're going to finalize this with the bigger picture. What you do matters. And I want you to think about this. I want you to think about this on a big scale. First, let's look at home ownership. There's a lot in the world today regarding awareness, socioeconomic status, education, all these different things. And so if we look at the beacon of American success, the beacon of financial success, we're going to look at home ownership. And so if we look at this from 1994 through 2018, we look at the percentage of Americans that are homeowners. White Americans, a little over 70%. Asian or Native Hawaiian, Pacific Islander Americans, close to 60, right? You can see Hispanic Americans, close to 50, Black Americans, a little over 40%, right? Well, when we protect people's mortgages, when we provide life insurance, what you're doing is you're allowing people who are on the lower socioeconomic status when it comes to home ownership, you're allowing them to climb forward and make sure a home is secured in the event of a death or a generational pass. Okay? If we're going to go from one generation to the other, what is the fastest and best way to increase wealth? Life insurance. Life insurance is the fastest and best way to increase wealth. So a little bit of discipline in budget can then have a huge payoff for all people, but especially when we talk about some of the areas that we work in, that we are grasping on how can we improve the socioeconomic status of this group? And life insurance can do it. How about widows in poverty? According to the Retirement Research Center in Boston, 1 in 6 widows fall below the poverty line upon the death of their husband. Now, does anybody know why, if we were talking just basically like Social Security? Okay, because you keep the higher of the two, but you're also losing one of the Social Security payments. And does your rent get cut in half? Does a gallon of milk get cut in half? Does a gallon of gas get cut in half? Absolutely doesn't. So what is unfortunate, I mean, it's tragic, is that we have women who live longer than men, okay, and who are outliving their husbands, and statistically 1 of every 6 of them is now in poverty. So do you think what you do matters? Do you think what you do has an impact? And all I can say is I remember so many times where the husband was the voice, the deciding voice with the husband and wife couple. But what he wasn't taking into account was that she would be the one that would have to suffer the most when he passed. So think about that and fight for that, because having people reach their 80s, their 90s and be in poverty is a sad thing. In this country, in this advanced age of first world country, it's the last thing that we want. Finally, higher education. Money and education, money and education. If we want to bring people up, if we want to effectively help people, hey, money and education. That is best accomplished with life insurance. According to the U.S. Department of Education, 60% of students from high socioeconomic statuses obtained a college degree and only 14% from low socioeconomic statuses. That makes sense. That makes a lot of sense. When I went to high school in Everett, I went to the downtown Everett High School. We had the highest dropout rate, the highest failure rate. It's not a mystery. If you see it, if you live it, if you experience it, you say, yeah, that makes sense. This person has less of a chance than I do. This person has a less chance than I do. How can you affect that? Hey, people are posting on Facebook. They're looking at videos and all things. How about actually doing something? How about helping people out with financial pyramid? Building a foundation that then they can structure on, and having life insurance secure a better tomorrow for the people who are going to be replacing them, for the next generation. And I understand it takes some discipline. I understand it's not the easiest thing to paint a picture on. It's not even the easiest thing to talk about, but it's important because what you do matters. These are 5 reasons why everybody needs life insurance and some high-level things that you're impacting when you go out there. So if you want to make a difference, sell life insurance. If you have any questions, email info@fflams.com. We will go ahead and send you a recording of everybody that registered and this presentation that you have for your records. We're going to open it up to the Q&A now. If the panelists can also join me. Okay, Rodolfo has a question. I'm going to answer this one live. He says, how does single pay life insurance work? And does it make the policy a MEC, a modified endowment contract? Okay, meaning that it would be taxable if you take cash out. I'm going to answer that with 2 parts, Rodolfo. One, not necessarily. You can do a single pay life insurance and have the death benefit high enough to where it's not a MEC. But two, a modified endowment contract, if the money is going to be used for death benefit, isn't bad. Okay. If when we think of an IUL, we're going to start taking cash out, then we don't want a modified endowment contract. But if the money is simply like, think of one of those irrevocable life insurance plans, okay, in a trust, or like an ILA, irrevocable life insurance trust, a MEC is fine because a modified endowment contract is only taxable if cash is taken out. It's never taxable as a death payout. So a MEC isn't a bad thing if that money is earmarked for a death payout. Okay. Gene, you have a client selling a home and wants to invest 100% of the proceeds into annuity. Would you recommend an annuity or an IUL? Gene, I would recommend an annuity. Okay. And the reason why, and I don't have all the things in front of me, so you can send the specifics to us and I can get real cute with it. But I would recommend an annuity because we don't want any of those proceeds to be eaten up with the cost of insurance. An annuity is a great holding place because now that money could possibly get a bonus. It's going to be eliminating fees and it will never have a market loss. It can grow from there. Now we can take pieces of that annuity and we could say, let's also set up a life insurance policy, whether it's an IUL. We have permanent policies now, guaranteed policies through North American, National Life Group is who I own my insurance policy through. We have a lot of options with there, but annuity would be the main holding place that I would switch that to, Gene. Matthew, Lay. What is the process for submitting clients' considerations for annuity? Excellent question. Bridget, can you explain to Matthew where the Ask a Specialist is? And even if you have the ability quickly to show you on your screen, that would be great.
Yes, absolutely. Let me see if I can get it pulled up. Matthew, so the Ask a Specialist form, which is what you would use for submitting a client who might be interested in an annuity and you're not sure what to do there. We have what's called the Ask a Specialist. It's posted on both your CRM through Family First Life and our own website, fflams.com. And let me see if I can share this. Can you all see my screen now?
Yep, I can see it.
Okay, and you're looking at the website? So this is the fflams.com website. If you don't have a login or access to this yet, you can email info@fflams.com to get set up and logged in. But right here at the top, Ask a Specialist, or down here, step number 5, Ask a Specialist. You can do either. And if you click on the form, it brings up annuity, IUL, Social Security, or just generic have a question. So specific to your question about annuities, this would be the form you would fill out. Ask pretty basic information, client, date of birth, spouse, where's the money coming from, what do they want to use it for, and then if you have any statements, you can feel free to attach those here. Once you submit that comes to me and my team into a ticket system, and we will respond within 2 business days with proposals. We'll give you actual illustrations as well as walkthrough and training videos specific to that product. And if you have further questions after that, we're always happy to also get on a call and go through that with you. So.
Okay, thank you, Bridget. Jeb Brownstein, how do you get contracted to sell advanced products? Does it need to be renewed? So contracting is handled for the advanced market team, the annuities, the IULs, that's handled through Navi. And if you send an email, Bridget, is that the best way for him to send an email?
Yeah, contracting@fflams.com, and I just typed that in the comments there for you, Jeb.
All right, so I typed it into the comments there, the chat, contracting@fflams.com, and we can get you set up with any of the carriers there. Okay, we're doing great on time. I'll just pause for 30 seconds, see if there's any other questions. Someone raised their hand. Okay. Oh, does it need to be renewed? No, once you're contracted. I think there are certain continuing education stipulations you have with your actual license, but not with the contracts. Bridget, is that correct?
That is correct. After a period of time, it's usually, a year to a year and a half. If you haven't written business with them, they might, cancel your appointment, but we always have notice of that first.
Yeah. And Bridget, I just successfully answered 2 contracting questions correctly. So
I am proud.
I'm proud of myself. Yes. All right, everyone. Unless there's any other questions, we'll go ahead and wrap this up. We'll send it out to everyone. Thank you for your attendance. I appreciate it. And we look forward to having you on the next webinar. Chantel, oh, hi, Chantel. How are you? For clients over 60 who want large policies, IUL a good choice? Yeah, IUL is a great choice. There's variations. So Chantel, submit any scenario. And the reason I say that is not to give you a generic answer, but we have like the new North American policy, the Protector IUL, or the guarantee, I think it's called Protector IUL. It actually has a guaranteed death benefit, and it's really low cost per thousand. And so it's an IUL, but it's built more like a GUL. Okay, so yes, over 60, we're looking less at cash, right, everyone? We're looking more at death benefit. And that's exactly what I covered kind of in slide 4 or reasons 4 and 5 to protect your financial assets and to create a legacy. You're looking at that death benefit, and then the ability to access the death benefit regardless of cash, access the death benefit with critical illness and terminal illness riders. So yeah, Chantel, IUL is a great choice, but which carrier really depends. We swap it around quite a bit. Okay. Yeah, so Chris has a great question. Well, your kids say, just sell the house when you die. You don't need life insurance. Well, you're not going to sell the house and cover, and I don't know which state you're in, but you have the potential of state taxes. There's 18 of them, 19 if you count District of Columbia. And then you have federal, okay, if there's any end of life expenses. But what costs would be associated with it? Who's going to pay to clean the house out? Who's going to pay for the funeral? Who's going to pay for the movers? Who's going to pay for those different things? So do you want them to sell the house and then reimburse themselves? Okay, that's fine. Keep in mind that when they're selling the house, it is going to have tax on it. So they're going to lose some of that money to taxation. They also eliminate the ability for them to live in it or to rent it. And I know people have done that too. They decide that they want to rent the house, keep it appreciating, and split the rental money. There's a lot of different things that they're going to have to truncate down to just selling the house if you don't have life insurance. And my question is this: if you have any other money set aside to cover those things, why not make that money a multiplier? Chris, let's say you had $100,000 to cover all your end of life expenses. I'm just using that as a random number. Okay, so that $100,000 is $100,000. And when you go to die, it's $100,000. That $100,000 could be, hell, it could be $1 million in a life insurance policy. It could be $500,000. Which is more valuable, 500 or 100? Tax-free or subject to estate tax? Right. And that's what I'm talking about. Every scenario is a little different. You're welcome to submit the scenarios, but it's hard to make an argument against it based on the fact that you're going to tie an asset up now to cover all expenses. So that would be what I would approach if I were talking about with my kids, which I have 4 of them, by the way. And other than, I don't think any of them want me to die just yet. So it's going pretty well. Is any carrier offering long-term care rider other than Moo? So Jeb, when you talk about long-term care rider, are you talking about critical illness, terminal illness, the ability to access the death benefit if you need long-term care? Because if you are, the answer is yes. North American, National Life Group, F&G, all of them offer it. And I am positive that National Life Group is in California, to answer Chantel's question. If it's an actual long-term care rider, email Kim, okay? Kim at FFLAMS, and she can tell you specifically, okay? Because I don't know the answer to that specifically, Jeb. Okay. Matthew's got a question. When a client is completely blind on the fact that it's not an investment, it's a life insurance policy, how do I better explain it so I don't misrepresent? What I use, Matthew, is I talk about the financial pyramid. And I say, listen, the financial pyramid was not created by me or a life insurance company to sell more life insurance. It was created by financial experts, doctorates, people who have studied financial planning. And the reality is that at the bottom of that financial pyramid, we need protection. Protection is life insurance. Now, life insurance does not have to be term, does not have to be whole life. You have some choices in how you want to do that based on your personal preference and based on your goals. But this is not an investment. This is a protection layer that would then be the foundation for any other savings, growth accounts, and investments. And the difference is this: investments are subject to risk. Investments can include speculation. Investors are fine if the investment drops 20%. In fact, they'll buy more when the money is down. That's what a true investment is. So hopefully that helps. If you need anything else, let us know. Rebecca, for potential clients who are new to the idea of life insurance annuities and are skeptical, think it's a scam, etc., are they any independent third-party resources? Yeah, you know what, Rebecca? I will, my book is finalized, so I can speak to annuities, the 7 benefits of FIAs for retirement. My book was just completed. It's now published. And so the 7 benefits of FIAs for retirement is a great resource for annuities. And I do talk about life insurance in there to a certain extent. There's also a great book by Tom Hegna. I will try to find that and email the group. But I can definitely recommend my book for an agnostic and very factual view on where and how and why FIAs make sense. Does any carrier offer a child rider with a 70-year-old? Kim has a question. So she's asking about a child rider with a 70-year-old. Kim, I don't know. Can you email Kim at fflams.com and she'll answer that for you. And the book is I think the link to Amazon goes live today or tomorrow for the 7 benefits. So by all means, I mean, it's not for me. I think I make $2 on a book sale, but it's a great book. It's a great resource. If you all have any questions, let us know. All right, we'll go ahead and wrap it up. Thank you, everyone. Thank you, panelists. I appreciate you being on, and we'll